over to you, Gary, sorry. Good evening to all of you. It's exactly noon New York time and 6 o'clock over here in Europe. Welcome to our webinar on predictive accounting, driver-based budgeting, and rolling financial forecast. This webinar is presented by Gary Cokins and is brought to you by the Boston chapter as well as the Performance Management SIG. Larry, Gary, if you can go to the next page. So for all of you on the line, just a few words on the Performance Management SIG. We provide, the SIG is one of the new organizations within IMA. We provide thought leadership, a forum for exchange and best practices on performance management. And we want to act as an expert to help improve the performance management of your organization. You will see on the slide, there's a QR code. If you wish to join the SIG, which can only be a benefit, please use this QR code and you can register and we will approve your registration most likely. There we go. If you can move to the next one. Perfect. Just a few housekeeping topics. Please note that you're muted upon entry and you will be muted for the entirety of the webinar. Use the Q&A if you have any questions, although Gary will address the topic of questions directly in just a few minutes. So there we go, and I think we can go to the next slide. To receive full CPE credit, you must attend the entire presentation, answer all the polling questions, and complete the evaluation form. And for that, click at the end, at the icon at the end, and you will get to the evaluation form. And the link to the recording will be emailed to attendees along with a link to download your CPE certificate. With that, I hand it over to Gary.
Well, thank you, Deborah. It's a pleasure to present for this special interest group. I'm a long-term member with you and others. There will not be enough time. It's a long presentation for me to have a Q&A session. So I highly suggest if you want to ask me questions or just comments, there's my email address, gcokins@garycokins.com. So who am I? I'm Gary Cokins. I received my Industrial Engineering and Operations Research Bachelor of Science degree from Cornell University, 1971. My MBA from Northwestern University's Kellogg School of Management in 1974. If you were doing the math, I am 76 years old, but I feel like I'm 46. My career was sort of in three segments. First decade or so, I was with a large manufacturing conglomerate in the US, FMC Corporation, as a division controller. Then many years with consulting, 7 years with Deloitte, 5 years with KPMG, 5 years with Electronic Data Systems, that's now part of Hewlett Packard. And then for 16 years, I was with SAS. People, what's SAS? Scandinavian Airlines? No, SAS is actually the world's largest privately owned software vendor, 15,000 employees that specializes in data science and data analytics. I retired from SAS 8 years ago. Now I'm just having fun teaching, a few consulting projects and the like. I'm a native of Chicago. Go Cubs, go Bears, go White Sox. But I have been now 20 years in the Raleigh, North Carolina area, which is where SAS is located. 32 years of marriage, 2 grandchildren that are now college graduates and employed with jobs. Great. So who will benefit from this presentation? Managers who have previously struggled at promoting rolling financial forecast as an advance to the annual budget process. Managers who intend to champion driver-based budgeting and rolling financial forecast and they need a compelling call to action. And the reason I have champion in quotation marks is it's been my observation that although it's nice to have senior executives sponsor and advocate new ideas, concepts, often they are preoccupied with short-term priorities and firefighting. It's typically managers 1, 2, 3 levels down in the organization chart who ask themselves, how long do I want our organization to continue to perpetuate using stale and arcane or inaccurate methods? And they're the ones that will do a pilot project or a proof of concept to demonstrate to their colleagues, this is the way to go. So if you're several levels down in the org chart or early in your career, that's fine. I like presenting to you. And I love talking about management accounting. I am a 30-year IMA member. So my agenda, I first have to do a little bit of the basics of historical cost accounting, including activity-based costing. Be warned, it's not as bad as everybody thinks. And then we'll get into what's broken with the annual budgeting process, why we need to do a shift to rolling financial forecasts. And then we're going to have to put what I call, since I'm an industrial engineer, our industrial engineer hats on, because this involves capacity planning and classifying expenses as sunk, fixed, step, variable, and all. And then I'm going to conclude with the frustration that I personally have. What is taking so long for organizations to use these progressive methods? I love this cartoon, drowning in data, but starving for information. You have this poor beleaguered clerk, sad, shoulders hunched, paper all around him. And the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? I gave you the request this morning. Why don't you have the answer this afternoon? And the message here is there's a difference between data and information. Actually, invoicing systems, procurement orders and like. But you convert data into information, and you'll see how that presentation. I like to skip that. Real basics. Here's sort of a continuum of cost accounting. Project accounting, highest form of direct costing, but it's only for non-repetitive costs. Standard costing is pretty much universal. And even with service organizations like banks and insurance companies, and don't worry, I'll be talking about banks and insurance companies and service organizations. In the US, only 8 out of every 100 jobs make tangible products. So the other 92 are services. ABC, I call it a poor person's costing system, standard costing. You know, it's actually simpler to do. The message here, though, allocations are the bane of accounting. You'll see why in just a few minutes. Easiest way to explain ABC, imagine you go to a restaurant with 3 other friends. You order a little salad, the other 3 order the most expensive item on the menu. At the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and service lines also feel when the accountants take this large amount of indirect expense overhead and they allocate it like spreading butter across bread using allocation factors like number of labor hours, number of units produced or delivered, sales amount, square feet, number of employees per cost center. None of those reflect the true consumption that those outputs have of the end-to-end business processes and the work activities that belong to them, which in turn draw on the expenses. So if you basically decompose all those indirect overhead cost pools into multiple pools, trace and assign them with a cause and effect relationship, you'll discover, compared to that butter spreading, many of those products were way overcosted. The others must be undercosted because it's a zero-sum error game. And compared to ABC, ABC corrects for that error. So the definition of ABC in this example is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, the reason there's become interest in the last few decades in ABC has to do with this diagram. Notice it shows that the overhead is displacing the direct or recurring labor. When you ask people why, they say, well, automation, robots, kiosks and so forth, that's secondary. They're displacing the frontline workers. That's secondary. The main reason for this expansion and displacement is over time, all organizations have had an increased proliferation of different types of products, more manufacturers, more colors, more sizes, more ranges, banks, more type of depository accounts. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity causes the need for more and more, if you will, indirect expenses to manage it. Now, I'm going to skip to this one. The problem actually begins with the traditional responsibility center statement. Every manager on the planet Earth recognizes this statement. But when you ask them, what do you learn? They say, not much. I don't know. I don't know basically where it went or what's causing it. Notice at the bottom, I say, when managers get this kind of report, they are either happy or sad, but they're rarely any smarter. ABC makes them smarter. How? It translates that same 914,000 into the middle, into the language of work. Key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then we reassign the activity cost into the products or customers, just like the waiter or waitress in the restaurant, based on a cause and effect relationship. Now, I'm going to rotate that simple diagram into a multiple stage assignment network. Now, hang in there. It's not as complex as you think. It has the three universal components of any organization's expense and cost structure, has the resource expenses at the top. They get converted into the work activities in the middle, and then they eventually pile up into the final cost objects at the bottom: products, services, customers, business sustaining. Each of those arrows, think of those arrows as thin straws or wide pipes where the diameter reflects the amount of money that's flowing through. That's why this will always reconcile exactly to the dollar or euro or whatever is the currency, whatever is the currency. At the bottom, the final cost objects, I refer to this as the predator food chain. You know, large mammals eat small mammals eat plants. You notice that the customers at the very bottom are consuming the products, but they're also getting some direct costs for sales and marketing and channel expenses and the like. In your mind, reverse all the arrows so they're going the opposite direction. They're going from bottom to top. That's what's happening in any organization every minute, hour, day, week, month, year. The customers and the products are placing demands on the workload's then drawing on the spending, and the costs measure the effect in the other direction. It's a principle. Causality is a principle. Rules are many, principles are few. Principles like speed of light, gravity, you can't violate it. The message to this diagram is costing is modeling. It is not T accounts and journal entries. Now, because I went through that fast, if you go to the IMA website, I authored several years ago one of the Statement of Management Accounting, SMA. When you get the slides, you can click on it, or you can go directly to the IMA website, click on, do a search on my name, and you can read about it and really most of the rest of my slides. So we're at polling question number 1. And I'll read the next, and then I'll go to the radio buttons. Our organization's cost accounting system calculates only direct material and labor product costs without overhead cost allocations. Product costs with a single overhead cost allocation factor, one large pool without any causal relationships. Product costs with multiple overhead cost pools and cost allocations using activity-based costing principles with causality. Finally, product channel and customer cost using ABC. There is the radio button, the 4 options. I'm going to keep my eye on the number of attendees that have clicked on it. When we get to 90%, I'll move on to the next slide. Oh, I'm realizing some of you are not looking for CPE credits. You're not bothering to vote. So looks like there's enough of them come in. I'm going to move ahead. Wow. Look at that. Almost 60% are doing it the old way. Usually when I see that, I say, I don't know if I should laugh or cry. ABC's been around for a couple of decades, and yet here, six out of 10 of you still doing it the old traditional way. The result of ABC is displayed in this graph. The vertical axis is the magnitude of error. The horizontal line is the traditional butter spreading of allocations. The backward, if you will, S-curve is ABC. You'll notice to the far left, simple products have been overcosted, and that's really scary because competitors will see that you probably did a markup on those overcosted for pricing. They'll come in under you, steal market share. On the right side, basically for the complex products and services, they've been undercosted, They've actually need much more expenses to be assigned to them, and it's not. And the problem there is the sales force thinks they're profitable, so they're selling more and more of unprofitable products. The result is you keep losing money as the salespeople sell more. Here's a real graph of the result from ABC from a real company. The vertical axis is the net revenues minus the properly calculated ABC cost. The horizontal axis is the cumulative buildup of the profit, rank ordered from the most profitable product to the second most profitable product, and so forth. The graph looks like a humpback whale. In fact, that's its nickname, humpback whale. It's always a shock to the organization when they see the top line, because in this case, it said you made roughly $8 million of unrealized profit on 3/4 of your more profitable products. You lost $6 million on the remainder to net out at 2. And notice the last data point will exactly reconcile with the P&L. And they can't believe it because their belief system with the butter spreading is it's this blue line. Oh, almost all our products are profitable, and there's a few that are less profitable. It's a shock. You basically, this humpback whale shows up all the time when you do ABC. Now, some of you are saying, oh, you're kind of convincing me we should do ABC at our organization, but it's a mudslide of data. Every employee will have to fill out a daily timesheet, and employees hate timesheets. There'll be 3,000 activities in it. It'll be unmanageable. We have to extract data from the MRP or ERP system. All of those are misconceptions, but they weren't misconceptions several years ago, and that's why a lot of organizations did not bother at ABC. I came up with an alternative method that can implement ABC in 3 weeks. It starts with a one-day workshop with 5 or 6 cross-functional employees in a room. You build a high-level ABC model very quickly. Not worried about accuracy, just want to kind of get the elements in, the expenses, few cost pools, and to product families maybe, okay? Next morning, bring in the other line managers, the executives, they see it. Very engaging. It's their own company. The light bulbs go on with all of them. Oh, that's how we get rid of that butter spreading of overhead. Oh, that's how we could validate whether our pricing is valid. Couple more iterations for a week or 2, permanent, repeatable production system. Done. Not 6 months. The reason rapid prototyping works has to do with this graph. The vertical axis is the accuracy of what you may want to know. Just let's say product cost or a service line cost. The horizontal axis is the administrative effort to collect the data, calculate the data, report the data. Notice you will always get an asymptotic curve that goes up very quickly, hits the elbow, and to the right, diminishing returns on extra accuracy for the extra level of effort of work. Stop at 90%. Good enough. So much better than that butter spreading. And this is not external compliance financial reporting for government regulatory agencies. Yes, if you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail. Now, when you ask people, what do you think influences that slope to make it go up so quickly? It is the multi-stage cost assignment network. It's the piping in that diagram is what creates the accuracy. Benefits from rapid prototyping: accelerated learning, people get it, solves that leveling problem. Is they're going to have 3,000 activities, typical ABC model, 60 to 70 activities. It prevents over-engineering, which is why they became unmaintainable or would collapse under their own weight. Also, I didn't mention that, but I will now. At the end of that workshop, I ask all of the participants, the line managers, in 3 weeks, when this is done, What will you do with this information? What kind of decisions? Put it on the flip chart, because we want them to commit in 3 weeks to actually use the data and make decisions. Now, let's move on to the topic, but we're already at polling question 2 about before we get to budgeting. What do you use as your primary reporting system? Corporate performance management methods, enterprise resource planning, like a SAP or Infor, business intelligence tools, data analytics, spreadsheets. There's your 5 choices. I'll wait for the majority of you to have replied. And I only have 30 minutes. We will end on time, so I'm going to really race. I hope you put your seatbelts on. I'm going to be going through many of the next slides fairly quickly. Okay, the majority of you are in. And not a big surprise. The majority are using your ERP system or other corporate performance management tools. So let's talk about budgeting. Why is the budgeting process broken? The budget is typically a fiscal exercise done by accountants that has 2 problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. It's not volume sensitive. Now, this is meant to be a little funny. How many of these apply to you and your organization about your budgeting exercise? It's invasive and time consuming with few benefits. It takes 6 months from beginning to end. We start in July to end in December. It requires 2 or more executive tweaks at the end. The executives don't like the first draft of change some of the numbers. It's out of date in a couple of months anyway. Starts the departments with truly valid needs. Maybe in the next fiscal year, a department's going to need a lot more manager or a lot more employees. We don't give them enough. It caves into the loudest voice and political muscle. That's to those veteran sandbaggers who have been in there 10, 20 years. They know how to game the system. It incorporates last year's inefficiencies into this year's budget. The process is inefficient last year. We're duplicating it this year. And finally, use it or lose it spending. When a manager is on a glide path and in the 3 months to go, they see they're not going to spend all of the approved budget, what do? They start spending foolishly, needlessly. It's because they know that the amount of spending next year is going to be pegged to how much they spent this year. Let me see if I describe how you do budgeting in your organization. You give every manager a spreadsheet January to December for all of their ledger expenses, including travel and paper clips. Everybody fills it out. Someone in the accounting department consolidates it. You get a forecast from forecast sales about sales volume. You create a P&L. You give it to the executives. They say, change some of the numbers, not enough profit. Spreadsheets go back down. People reduce some of their spending. Back to accounting, consolidate the spreadsheets. Back to the executives. That's a little bit better, but not enough. Up, down, up, down, up, down, up, down. Come on. You almost want the executives to answer, what number did you want in the first place? That'll save us all of this spreadsheet manipulation. But that would give us their aspiration. We want to know what's realistic. So how can we get realistic? It's through driver-based budgeting and rolling financial forecasts. The way to think about this is these are 2 river streams coming at the organization. The upper river stream is the recurring, repeatable expenses. It will be customer demand driven. The bottom river stream is the non-repeatable, non-recurring expenses, and that will be coming from projects. Projects have beginning to end. So let's talk about the 2 river streams. We'll start with the top river stream. With the activity-based costing, it's historical. It's primarily used for strategic profit margin analysis, although you can use the activity cost to support lean accounting, value stream maps, and so the process people can basically reduce cost, cycle time improvement. But when you go to the predictive view, we calculate the ABC model backwards. We start by estimating all of those activity drivers to solve for the level of resources that are going to be needed. But we're going to need an important number, unit level consumption rates. So this diagram is the backward calculation. We start at the bottom, we calculate to the top. Now, with the historical view, I call it morbidly, it's like the cost autopsy. The spending's known, we calculate the cost. but we get a bonus. We get unit level cost consumption rates for every one of the activity drivers. So if we had 70 of them, we've got 70 activity drivers, okay? Now, and I call this Industrial Engineering 101. I think it was my second semester freshman year at Cornell University, 1967. The equation, that sales, demand, volume, and mix times those unit level cost consumption rates equals the capacity required, meaning the number and type of employees and their salary level or wage level and purchases with suppliers. So that takes care of the operational expenses. Now let's talk about the lower non-river. And I've got to go very quickly. The basics of this is you're looking at a Kaplan and Norton, Professor Robert S. Kaplan with the strategy map, which turns into the balanced scorecard. This is a quick view of the strategy map that they created. The reason they created it is they saw that executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics reported during the period. And then they created this map that goes from learning and growth, the internal process improvement, to customer retention and loyalty, to financial results. Each of those arrows, those are KPIs, those are measures. You get what you measure. To summarize it from bottom to the top, a learning environment stimulates process excellence, leads to customer retention and intimacy in the financial results. Now, what this diagram is showing in each of those strategic objectives are 5 elements from left to right. And what I'm showing in this diagram, I encourage you to delegate the managers, employees to be involved and have them identify the projects and initiatives to accomplish those objectives, or in some cases, core processes. But what happens if we don't give them the money to do that? Well, then we don't accomplish the strategy. And that's bad. A lot of executives have been terminated because of the inability to execute the strategy. Carly Fiorini at Hewlett Packard being a good example. So if we spend money, now we basically can accomplish it. Another type of project are risk mitigation projects. This is a popular slide by the enterprise risk management community. Each of those circles is a type of a risk event that could happen in the next fiscal year. The vertical axis is the severity of it. How painful will it be? The horizontal axis is the probability. Now, obviously, you can't mitigate and spend money on all, but for the upper right ones, spend money to mitigate it. So let's get back to our 2 river streams. For the upper river stream, we use the backward calculation with unit level consumption rates to calculate the level of spending of operational expenses. For the lower river stream, we've got 3 types of projects. I already mentioned 2. One are the strategy projects in strategic objective projects in the balanced scorecard. The other is risk mitigation. Third one, you're all familiar with, capital projects that have already been justified with their ROI in decisions in the past. Now, I've decomposed the diagram. I'll take you through it really quickly. You're going to get these slides so you can look. The shaded boxes is the upper river stream. So notice we've got management accounting. We got unit level consumption rates coming in from the top. We got forecast drivers from the left. We calculate that. We get a capacity resource plan, number of labor hours, pounds, kilograms, number of employees. We monetize it. Now from the left are the 3 projects I meant: capital projects, strategy projects, risk project. That is going to give you a much better and realistic number than, remember, those spreadsheets by all the managers. But we're still going to have the same problem with the executives. Notice that baseball diamond acceptable. If they don't like the level of profit, they're going to say, go back and change something. Well, the temptation might be, why don't we eliminate or postpone some of the risk mitigation? Bad, we expose ourselves to risk. Why don't we eliminate or postpone some of the strategy project? Bad, then we can't implement our strategy effectively. Why don't we eliminate or postpone some of the capital project? Bad, we already justified them. The only lever in this diagram to increase profits by lowering costs, unit level consumption rates, that comes from productivity improvement, like from lean management or Six Sigma. So as we basically do cycle time reduction, quality improvement, we'll lower our expenses. We're at polling question number 3. Which type of expenses is not project-based? Operational expenses, the strategy execution expenses, risk mitigation expenses, and capital expenses. Which one is not project-based? You've got your you got your four choices. Move faster, I'm running out of time. Almost there. Okay. And half of you got it correct. The operational expenses are not project driven. The other three are project driven. I love this cartoon. Don't treat forecasting as a special event. You've got these three guys at the table. They say, we haven't forecasted in a while. Maybe we should try that again. Forecasting should be an ongoing part of monitoring the business. So what this graph is showing is the accuracy of a forecast. So the vertical axis is the accuracy, the horizontal is the time horizon. Notice it declines over time. Any forecast will become less accurate one day, 1 week, 1 month after we basically do it. So reforecast. And I'm not going to go back to that kind of dense diagram, but when we refresh the forecast, it's the only independent variable in that diagram. The unit costs have been calibrated, everything else has been calibrated, or it's discretionary. So that way we can refresh the forecast quarterly, maybe even monthly, and now we move to rolling driver-based rolling financial forecast. And they will be capacity sensitive. We need to talk about capacity now. In the very short term, you would not fire employees on a Tuesday because there was a low workload, open orders in the house, and hire them back on Wednesday. Of course, you'd keep them for Tuesday, but you'd incur what's called idle or unused capacity. But as we go forward in time, in the future, you may replace full-time employees with contractors, or you may lease assets that you might have purchased. So now you're basically getting not a depreciation expense, but a variable expense. So in the diagram, I've got the vertical axis is the effort level to adjust capacity up or down, and then the time horizon. It's very difficult in 1 day or 2 days or a week to add or remove. But as we go into weeks, months, years, it becomes more variable. So I'm sort of replicating that previous slide. To the left, that's the historical expenses. Remember our multi-stage cost assignment number used for strategy, price margins, process. But when we go to the predictive view, notice I have a horizontal line going from the bottom left to the top right that's differentiating the fixed expenses and step fixed. And the variable is at the bottom. So the message here is as the time horizon goes out, more and more expenses can be classified as variable. You may want what's step fixed. Just real quickly, resources come in discontinuous amounts. You can't buy a half a machine. You can't hire a third of an employee. It's kind of an all or nothing. It gets step fixed. Now, what we're really then talking about in this predictive view is marginal or incremental expense analysis. Some of you may remember this from your college textbooks. Most savvy managers know that some of the expenses are fixed in the short term, but they become variable in the long term. They want to know the impact of any decision. And examples of decisions: adding a product, dropping a product, dropping a customer. Let's say we have a real unprofitable customer that's large. We drop the customer. What's going to happen? Well, the revenues go away, but not necessarily the expenses. So we have to basically work on that. Make versus buy decisions, outsourcing decisions or not, capital investment justification. Remember the ROI and rolling financial forecast, just as I mentioned. I tell everybody that my career is over. It's now a vocation. Career, all of you listening to me have careers, salary increases, job promotions. Mine's a vocation. It's a calling. I want to make a difference. How to get CFOs and accountants out of the 1980s into the 21st century. And I often say you got to think like an engineer, and that's the way I did. I was so fortunate in my career. At the age 27, I became a division controller in FMC in Milwaukee. But I had the chance to then become the operations plant manager in that same facility. And now I use the phrase, I had to eat the accounting data that my successor controller upstairs was serving us. I found much of that information to be at best useless and at worst, misleading. And that was a real wake-up call to me of the difference between external compliance reporting for the SEC and internal management accounting. We need management accounting for better decision making. I'm going to start moving real quickly. This is a diagram that I created for the International Federation of Accountants. Many of you may not be familiar with them. They're in New York City. They're like the global accounting, they're like the United Nations of global accounting institutes, AICPA, IMA, many in Europe, India, so on and so forth. And what I'm showing here is a taxonomy, like in biology, plant kingdoms, animal kingdoms. So at the top, you can see the three, if you will, kingdoms of accounting: tax accounting, financial accounting, management accounting. Now let's follow the managerial accounting to the next box. All costs are calculated. Expenses and costs are not the same thing. You may think they are, but they're not. Here's why they're different. Expenses are when you exchange money with third parties or pay employees. Currency exits the treasury like writing a check. All costs are calculated: process cost, activity cost, product cost. Now, after we've calculated the cost, to the left, we use GAAP, generally accepted accounting principles, these rules, and they tolerate that butter spreading. And that's used for the external compliance reporting. But for management accounting, notice go straight down. We've got cost reporting and analysis. So this is basically where we get insights to make decisions. Now, I've got that as the historical view. For the predictive view to the right, which is what I just talked about so far in this webinar, it's about decision support and cost planning. So that's where we get incremental and marginal expense man, driver-based rolling finance, of course. Now, some accountants aren't particularly, especially CPAs, are not particularly fond of me in this diagram, because at the bottom, I've got what I call the value spectrum. Notice at the far left, low value added. That's the financial accounting. In the middle, as we move to management accounting, reporting and analysis, modest value add. To the far right, high value add. The message here is the value of accounting increases as we go left to right. And notice where we are at the right. It's about the predictive view. That's why I titled this webinar, Predictive Accounting. We're at our polling question number 4. The financial budgeting process at our organization is mainly based on 1A, rolling up and consolidating each manager's cost center expense reports, with incremental changes from prior year. Remember all my spreadsheets, up, down. Spending projections that come from a budgeting staff without involvement of any of the employees. Driver-based equations annually using the unit level cost consumption rates annually. Driver-based equations, same, but now updated frequently during the year, such as quarterly or maybe even monthly. Which one do you use of those 4 in your organization? Let's go. I got to keep moving. Keep clicking one of the 4 radio buttons. All right, we're almost there. Oh, so there we go. 1 out of 2, almost 50%. You're doing the old, give each manager a spreadsheet and roll it up, down, till it satisfies the executive's need. So I want to do a broader picture here. My experience with activity-based costing began when I got recruited to KPMG in 1988. They struck an exclusive contract with the Harvard Business School professor, Robert S. Kaplan. And Kaplan didn't invent ABC. He just researched. It's just full absorption costing done correctly and validly, okay? But as time went by, I started moving into thinking how all these other moving parts fit together, risk management, strategy management. And I then started writing books on corporate performance management, CPM. And this is a diagram on how all these pieces can fit together, including management accounting. Very quickly, think of the big blue box like your heart, and these are the veins in your system, all these veins that are, going through, right? But notice at the top where customer loyalty goes all the way, swings to the right and into the shareholders and owners. Customers are the source of financial wealth creation for shareholders and owners. Okay, so how does this circulatory system work? Well, before I go, where's management accounting and analytics? I deliberately did not put it in because the output of management accounting and analytics is the input to so many other places. It's ubiquitous, it's pervasive. Now, how the diagram works, start at the customer satisfaction box and go to the left. The executive team will formulate their company strategy based on the needs of customers. Then they will communicate it to the employee teams and managers using the Kaplan and Norton strategy map and balanced scorecard. And there's a variety of other RACI strategy management techniques, but that's where that'll take place. The result is there'll be KPIs, key performance indicators, measures. You get what you measure. If you can't measure it, you can't manage it. And that KPIs goes back in as feedback. A balanced scorecard, incidentally, is, well, the strategy map in my mind is 99 times more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. It all starts with the strategy map. Once the employees can see their KPIs daily, weekly, they just open their screen up in the morning. Is it favorable or unfavorable to the target of the KPI? They can answer the question, how am I doing on what's important? That would be nice if everybody could answer that question. And this way, everybody can. Now we go to the customer level, CRM, customer relationship management, targeting. The sales and marketing team needs to know answers to this question. What type of customer is more attractive to retain, to grow, win back, and acquire? Which types are not? That's where customer profitability information comes in. Now we've got the counterclockwise circle. This is the process view. This is where the lean management and Six Sigma operations people come into play. They may not care about margins, but they care about lowering costs. And there is a universal end-to-end process in any organization. Order fulfillment. Take the customer order, complete the order. So good. I hope you can see these bubbles flowing through the veins in this diagram. This is what's happening every minute, hour, day, week, month, year. These are flowing. And if any one of those veins are constricted, I refer to it as arteriosclerosis of the corporate performance management system, which would lead to a heart attack in a human being. If any of those are restricted, we need to basically widen them. So to me, it's a tribute to the executive team to know how to prioritize. If you're not doing any of these CPM methods, and there's 5 or 6 of them, they're like gears in a machine, they all mesh together. If you're not doing any of them, the executive team has the challenge, which should we do first? So if the employees don't understand what to, their KPIs or their strategy, do the strategy map balance score. But if we don't know what things cost, where our margins are, do activity-based costing. And to the degree that some of the processes are still inefficient, or we're still pursuing unprofitable customers, notice the money doesn't go all the way to the shareholders and owners, it leaks into the sewer. I'd like you to think of this diagram as the vision of where you want your organization to eventually get to. Now, there's an issue here. There has been a shift in the source of return on investment from tangible assets to an intangible asset like information, meaning the shift is from, return on investment buying trucks or machines or computer hardware or software to information. And notice in this diagram from left to right, as we go from data to information to knowledge to insights to decisions, the return on investment from information increases exponentially. The problem is many organizations are stuck in the two left bubbles to the left. All they've got is raw data and standard reports. All they can answer is what happened. When we get to the third bubble, maybe the IT director will give some of their managers some what's called business intelligence software so they can drill down to an anomaly in an invoice or a purchase order system, but they're still limited to only knowing what happened. The corporate performance management methods begins with the first blue bubble. It's descriptive modeling. I mentioned costings modeling. Strategy map is a model of the organization strategy. When you're in that first blue bubble, you not only know what happened, you know why did it happen. And that's because we're complying with the causality principle. Now, when we go to the predictive modeling, the next bubble, now we're into budgeting, driver-based rolling financial forecast, what if scenarios. We not only know what happened, why did it happen, what can happen. And scenarios is really the way to go. And as way back to the diagrams where I had the two river streams, that one diagram, computer software, FP&A software vendors, not all of them, financial planning and analysis software vendors, can basically do that modeling for you. And when we get to the third blue bubble at the top, it's now prescriptive analytics, which is really optimization. When we reach that level, and very few organizations are at that level, you not only know what happened, why did it happen, what can happen, what are the best choices that can happen. So I want to conclude with my frustration. What is taking so long for organizations to implement these? Why has the adoption rate for driver-based budgeting, as well as all of the EPM and corporate performance management methods, been so slow? Three of the obstacles and barriers are here. The first one is technical barriers that include IT-related issues, such as dirty data. We had bad input data. We had, in the old days, key punch errors, what have you. But IT has a solution tool called Extraction, Transform, and Load, ETL. Think of it like a water purifier. It can clean up the data. The next problem is the perception barrier of excess complexity and affordability. I'm sure when I was talking about ABC earlier, many of you were saying, oh, ABC is too complicated. We're not going to do it here. It's impossible to do, too big. And then I demonstrated with rapid prototyping with a few iterations, permanent, repeatable production ABC system in 3 weeks. Similarly, with Strategy Map, I have another workshop that can produce the balanced scorecard in 2 days. Incidentally, for any consultants that may be attending this, feel free to directly communicate with me, because at this point in my career, I enjoy training others, consultants, how to implement the methods that I've been doing all my life. Let you do it. But the real obstacle is the last one. It's organizational behavior barriers that involve resistance to change, culture, and leadership. It's human nature. People don't like this. People want the status quo. Don't rock my boat. But there's other barriers. Oh, I don't want other departments to know the truth. I don't want other departments to know my expenses. Fear of being measured, fear of being held accountable, weak leadership. There, I said it. Notice none of those barriers have anything to do with systems or software or technology. It's all about people. What this means is you need soft skills like change management in addition to your hard skills to be successful. I'm going to quickly end, I think, with more excuses why people are not at Progressive. The first one, we're profitable, so why does it matter? Yeah, you may not be profitable for in the future. We'll purchase software that'll fix our problem. No, software, a fool with the tool is still a fool. You got to really know how to model that software. We already know our true expenses from our general ledger financial reporting system. As I mentioned, no, you know your true expenses. You don't know your true cost. You calculate the cost. We have done it this way forever. We don't do that here. We already know everything. It's in our heads. Pretty arrogant. We're a small organization. We'll worry about better methods when we get larger. Well, guess what? You may not get larger. And a question I'm always asked, how large do you have to be to put in these methods? I start 25 employees. You don't have to be hundreds of employees, multiple divisions. 25 employees, still this applies. All this hype is made up from highly paid consultants. Well, let me defend the consultants. They can do something you can't do. Focus. They've got a consulting engagement letter. They're going to get that consulting engagement project done. No one looks at the reports I create. So there is no point generating better reports. Oh, that's sad. Here's an accountant that's doing a good job, gives it to their managers, they throw it into the trash can. We cannot afford better software to fix our problems. You'd be surprised at the low price of much of this commercial software. We are way too busy doing other things. What's that? Closing the books. You take 3.5 weeks with 2 days left over. Go to a continuous close. And finally, we don't know where to start and how to get started. And my answer is rapid prototyping with iterations. So this analogy here, I've got 1 minute. All I'm doing with this slide is saying, that's a cover of one of my books on the left. Greasy, grimy gears, teeth broken. That's not going to work very well. Look to the right, titanium gears, spinning faster revolutions per minute. Now just imagine that the measure is actually rate of shareholder wealth creation. We're speeding up shareholder wealth creation. I'll conclude. Action steps, get educated. Thank you, you're doing that. Get buy-in, rapid prototyping, start small, think big, go fast. And I'm not an expert in incentive theory, but it's going to be important. 3 of my articles are in those links, and I have somehow managed to land the plane exactly on the hour. There's my email address. And if you go to my website at garycokins.com, below the horizontal tabs are a lot of free articles. You don't have to buy anything from my website. It's all free. Thank you very much for attending. I'll hand it back to Deborah.
Gary, a huge thank you for this exceptional presentation. And you perfected this. Indeed, we are exactly at the hour of 7 o'clock. Again, as Gary said, should you have questions, please send them directly to him. And with that, I will now close the session. Thank you.